this is Julius from Basic Financials. This video is going to be about payment of tax on the 31st of January. Now this mainly relates if you're self-employed, but it could also relate to if you have dividends and other types of income, or if you've got rental income, for example, and you're doing it's normally when you're doing a self-assessment tax return. Now the payment on the 31st of January can sometimes be a little bit confusing. For example, now let's say you've just started some self-employment, you've been doing it for a year, you did some accounts up to the 31st of March 2019, let's say, or 5th of April 2019, so you're doing your 5th of April 2019 tax return. You won't have paid any tax for that year on account because you've only just started in that year. So let's say that you've got profits, so that you end up having to pay tax of £5,000, tax and what they call Class 4 national insurance. We won't go into how to work it all out. This is just purely about the payment of tax and what's due on the 31st of January. So let's say your tax bill is £5,000. Now, you would think, quite understandably, okay, 31st of January, I've got to pay £5,000. Well, you don't, unfortunately. You will have to also pay an amount on account for the following year. And the way it's normally worked out is based on the profits for the previous year. So the HMRC will assume that your profits are going to be the same, and therefore your tax bill will be around about the same. So instead of paying just £5,000 on the 31st of January for your tax for the year ended 31st of March 2019, you will also have to pay another £2,500 on account for your tax for the year ended 5th of April 2020. So all of a sudden, rather than paying £5,000, you're going to have £7,500 to pay. And not only that, 31st of July 2020, you're going to have to pay another £2,500, which is your second payment on account for the year ended 31st of July 2000, for the year ended 5th of April 2020. Now, if your profits stay round about the same, and the tax rates and tax bands always stayed the same, you would end up paying £5,000 in January, £2,500 in January, £2,500 in July. Same again, every year you'd pay £2,500 in January, £2,500 in July, £5,000 for the year. Now that first year you've had £7,500 because you haven't paid anything on account. If your profits suddenly increased, then your tax bill would go up, and you would have a balancing payment on the 31st of January, which would account for what the tax that's due above the £5,000. But again, they would then also assume that your profit's going to be higher the following year and base your payments on account for the same. So let's say your tax bill actually came to £6,000, you would have paid £5,000 on account, so you would have to pay a £1,000 balancing payment on the 31st of January after the year end. At the same time, rather than £2,500 for your payment on account, it would be £3,000. So on top of what you would have been paying, £2,500, you'd have £3,500 for that £1,000 extra tax that you had to pay as a balancing payment, plus an extra £500 because your tax bill's gone up. So you're all of a sudden going to be paying £4,000. So you need to watch out on those payments on account. Now the same could apply if you've got rental income. So let's say you've got you're normally employed, you pay most of your tax through employment, but you have some rental income. Maybe you've got some properties that you rent out, and you have some tax to pay on that. Now, if your tax bill is more than £1,000, then you would have to again pay a balancing payment and payments on account. Now, if your tax bill is under £1,000, or if your total tax bill is such that what you pay under your employment is 80% or more of your total tax, which it may well be if you're just rental income plus your employment, then you would not have to pay payments on account. You would just have a balancing payment to pay, or it could be collected via your tax code for the year. So they would make an adjustment to your tax code, so you'd pay your tax on your rental income through your PAYE, which you might not want them to do, because the timing thing. If you start doing that, then they'll start collecting the tax for the year that's just gone by, whereas you could have just paid it at 31st of January 9 months later, or 10 months later. So yeah, so that's a little bit on payments account, just to watch out for. Yeah, there are other videos that I've got on how to prepare your tax returns, and we talked a little about rent there. But yeah, just have you got any questions, leave them in the box below, and if you like and subscribe as usual, and I'll see you again soon for another video. Thanks for listening.